Say your 401k statement shows $4 million. That is the number you have been mentally spending for years, the one that means you made it, you are safe. You do not have to worry about money the way you used to. But only part of that balance is actually yours to spend. The rest is a standing bill to the IRS, and the due date is not up to you. Starting at age 73, the government forces you to pull a set share of that account out as taxable income every single year, whether you need the cash or not, whether the market is up or down that year, whether you already have enough coming in from other places. That single mandatory withdrawal is what sets off what I call the three-way squeeze. It pushes your regular income higher. It can pull more of your Social Security into taxable territory, and it can trigger Medicare surcharges that add hundreds of dollars a month to your premium. One number you do not control. 3 separate bills that all show up at once. In a minute, I will show you exactly what that first forced withdrawal looks like in real dollars on a $4 million balance. And it is bigger than most people expect, even people who think they have already done the math. If you are sitting on 7 figures in a 401k and nobody has walked you through this math yet, subscribe. This channel exists to help you keep more of what you built, not just tell you that you built a lot. Here is the number that actually matters. On a $4 million pre-tax balance, your first required withdrawal at age 73 works out to $4 million divided by 26.5, which comes to $150,943. Call it $151,000 of forced ordinary income in year 1 alone. Before Social Security, before a pension, before anything else gets added on top. That divisor, 26.5, comes from an IRS life expectancy table, and it shrinks a little every year you get older, which means the required withdrawal usually grows even if your account balance does not. So $151,000 in year 1 is closer to a floor than a ceiling. Whatever number you just did in your head, the real one a few years out is probably a bit higher. Once that money lands as income, it does not stay contained to one line on your tax return. If you are married and your combined income, meaning your adjusted income, plus any non-taxable interest, plus half of your Social Security, crosses $44,000, up to 85% of your Social Security becomes taxable. That threshold has not moved with inflation since it was written more than 3 decades ago, so it now catches far more retirees than it did back then. Then Medicare steps in behind it. IRMA is not a gradual slope, it is a hard cliff. Cross $218,000 of income as a married couple, based on what you earned 2 years earlier, and your Part B premium jumps from the standard $202.90 a month per person, straight into a surcharge tier up to $689.90 a month per person at the very top. For a couple who both land at the top tier, that is roughly $974 extra a month combined, close to $11,690 a year. And it is not a one-year fluke. If your income stays elevated, it can keep running for a decade or more of retirement, easily crossing 6 figures in surcharges alone over time. I call this the identity protection line, and I mean it as reassurance, not a warning. Needing a plan for a tax bill this size does not erase everything you did right to get to $4 million. It just means the next chapter needs a different skill than the saving chapter did. Nobody chose this trap on purpose. The default is to keep funding one pre-tax account for 30 years, because that is the path payroll sets up for you automatically, year after year, without asking. Your 401k provider never sends a note in your 40s suggesting you diversify how your future withdrawals will be taxed. It is not a villain doing this to you. It is an incentive built into the plan design, and almost nobody actively corrects it along the way. And this is not only a $4 million problem. The same three-way squeeze shows up at $800,000 or $1,200,000 just with smaller digits attached to it. The mechanism does not need 8 figures to bite. So the obvious next move is to convert as much as possible to a Roth account before those required withdrawals start, during whatever low-income window you can find, right? But there is a catch. For a lot of people, that window does not exist and never has, which raises the real question. What do you do if you are never going to get a zero-income year at all? Meet Frank and Diane. Frank is 62, Diane is 63, and together they have $4 million spread across 2 401k accounts. Diane still consults part-time, bringing in $70,000 a year, which means the two of them will never get the zero-income year that most Roth conversion advice quietly assumes you are sitting around waiting for. The fix works like this. Instead of waiting for an empty income year that may never come, you calculate what I call your room to the next bracket, the gap between your actual taxable income this year and the top of the bracket you are willing to fill. For 2026, the 24% bracket for a married couple filing jointly runs from $211,400 up to $403,550. If Frank and Diane's taxable income, after deductions, lands around $50,000 from Diane's consulting pay plus some interest, they still have roughly $161,400 of room. That is $211,400 minus $50,000 that they can convert this year and stay at or under a 24% rate on every converted dollar. That is smaller than the $211,400 a couple with zero other income would have to work with, but it is nowhere near zero. The window is not gone. It is just smaller than the version most videos show you, and finding your own real number matters more than finding a perfect one that does not apply to your life. I used to just tell people to convert as much as they could, as early as they could. I do not say that anymore because it assumes everyone gets a clean, empty income runway at some point, and most of the people I hear from do not get one. There is a second lever available once Frank and Diane turn 70 and a half. Up to $111,000 per person per year can move directly from an IRA to charity through what is called a qualified charitable distribution. That amount counts toward their required withdrawal for the year, but never touches their taxable income at all. It is not a fix for everyone, but if you are already charitably inclined, it is one of the cleanest moves on the table. If your numbers look more like $600,000 than $4 million, the room to the next bracket math still works exactly the same way, dollar for dollar. And you may still qualify for the extra $6,000 per person senior deduction added under the recent tax law, which phases out above $75,000 of income for a single filer, or $150,000 for a married couple filing jointly. That deduction is already fully phased out for a household sitting at $4 million, which is exactly why the room to bracket math matters more at this level, not less. That is the who can still convert half of the plan. But there is a second mistake almost every conversion plan makes, and it has nothing to do with your income. It treats the stock market like background noise. It is not. A Roth conversion is a taxable event based on the value of your shares on the day you convert. Convert during a falling market, and you pay full tax on shares that are about to be worth less which locks in a worse trade than simply waiting would have been. Put it in real numbers. Convert $200,000 during a 20% market drop, and you have paid tax on $200,000 of value that on paper is now worth $160,000. You are taxed as if you still had the higher number, even though it is already gone. Wait for a recovery, or at least pause while the market is still falling, and the same tax dollar ends up buying you more shares at a lower price. So instead of converting a fixed amount on a fixed calendar every single year no matter what, use a simple rule instead. Pause new conversions after a 15% drop in the broad market from its most recent high, and resume once the market reclaims that high. It is mechanical, not a guess, and it takes the emotion out of a decision that people otherwise tend to make under stress, usually at the worst possible moment, when the account balance is the last thing you want to be looking at. For context on where things stand right now, the Shiller-Cape ratio, a long-running measure of how expensive the stock market is, relative to average company earnings, sits at roughly 41.9 as of mid-2026, well above its long-run median, which sits in the mid-teens. That does not mean sell everything and hide in cash. It means a plan that assumes conversions only ever go smoothly upward, is quietly assuming away a real, ordinary risk that shows up sooner or later in almost every multi-year plan. I do not have a crystal ball for the market, and neither does anyone selling you one. This is not about predicting the next drop before it happens. It is about having a rule ready ahead of time, so you are not making the decision in the moment, under pressure, with your account balance flashing red on the screen in front of you. So what actually happens if you are 3 years into a conversion plan and the market drops 20% in that same year? Let's walk through it. Doing nothing has a cost, but it rarely shows up as one single bad year. It shows up slowly, as the quiet loss of choice. Stay entirely in a pre-tax account, and you let the required withdrawal schedule set your income for you, starting at 73, with Social Security taxation and Medicare surcharges landing wherever the math happens to put them that year. Nothing catastrophic happens in any single year on this path. The cost is quieter than that. Less control over which account you draw from during a down market. Less room to handle a large one-time expense without triggering a tax spike. Less ability to help family or give money away without extra tax consequences attached to every dollar. The other path holds a mix, some traditional, some Roth, some sitting in a regular taxable brokerage account, built gradually through the room to the next bracket conversions from a minute ago. In any given year, you choose which bucket to draw from, based on what that specific year actually looks like. A market drop, a large medical bill, a grandchild's wedding. You are choosing, instead of the IRS choosing for you by default. This is not about squeezing out the biggest possible number on a spreadsheet by the time you are gone. It is about having options available when life does not go according to plan, which, if you have lived long enough to have $4 million, you already know it usually does not. Nobody signs up for that trade on purpose. Most people just never notice they made it, one automatic default at a time. For Frank and Diane, the real difference is not a bigger balance sitting at the end of the road. It is whether they are choosing their withdrawals or simply reacting to them year after year. That sounds like a slow, long-term difference, and most years it genuinely is. But there is one specific kind of year where it stops being slow and becomes obvious fast. 3 years into a Roth conversion plan, the market drops 20% in a single year. That is not some wild hypothetical dreamed up to scare you. It is an ordinary risk that any multi-year plan has to be built to survive. Picture the unprepared version first. Someone on a fixed conversion schedule keeps converting the same dollar amount on autopilot, right through the drop, paying full tax on shares at their pre-drop value. That money lands in the Roth account, still down along with the rest of the market, and it can take years just to recover the ground lost on that one specific conversion, let alone get ahead. Now here is the framework version, the one built around the 15% drawdown rule from a minute ago. Once the market falls past that threshold, new conversions pause completely. No exceptions, no second guessing in the moment. Once the index reclaims its prior high, conversions resume right where they left off, at the same pace as before. Same total plan, same end goal, just resequenced around the shock instead of pretending it will never happen. This is exactly the situation Frank and Diane would be in if a downturn hit during year 3 of their own conversions. Nobody in this scenario loses everything or runs out of money. The difference between the two paths is efficiency, not survival. The point here is not that the sky is falling. It is that there is still a choice available, even in the middle of a plan that is already well underway. Starting a multi-year conversion plan from an elevated valuation level, which is roughly where things sit heading through 2026 based on that Schiller Cape reading from a minute ago, makes a mid-plan drawdown a real possibility worth planning around, not some remote edge case you can safely ignore. All of this assumes you actually have cash sitting outside your IRA to pay the tax bill on a conversion without touching the account itself. That single detail trips up more people than the market ever does, and it is the very next thing worth getting right. Here is how this actually works, in 4 moves you can take this year. First, calculate your own room to the next bracket. Take your current taxable income and subtract it from the ceiling of the bracket you are willing to fill, using this year's numbers the way Frank and Diane did a few minutes ago. That single number replaces waiting around for a zero-income year that may never show up on its own. Second, fund the tax bill from outside the IRA. Use cash or a taxable brokerage account, never a withholding pulled straight from the conversion itself. This is the part that trips people up more than anything else. If you pull the conversion tax out of the IRA balance you are converting, you have just shrunk the very account you were trying to grow tax-free. And if you are under 59.5, you have also triggered an early withdrawal problem on top of it. The tax has to come from somewhere else, every single time, no exceptions. Third, write down the 15% drawdown pause rule before you actually need it, not while you are watching your account balance drop in real time. A rule you set in advance is a decision. A rule you invent in the middle of a crash is a panic response wearing a decision's clothes. Fourth, if you are charitably inclined and 70.5 or older, route part of your required withdrawal through a qualified charitable distribution, up to $111,000 per person in 2026, before you convert anything else that same year. It reduces your taxable required withdrawal directly, at no extra cost to you, and it does not require anything complicated on your part. Frank and Diane built their own plan around these same 4 moves, 1 bracket check and 1 bank transfer at a time. I have seen this happen more than once. Someone converts a big chunk, feels great looking at their new Roth balance, and then gets a surprise tax bill the following spring because the conversion tax came out of the account itself instead of a separate bank account. It is a completely avoidable mistake, and it is one of the most common ones I run into. If you did the room to the next bracket math right now, with your actual numbers, would it come out closer to $20,000 or closer to $200,000? That number alone tells you a lot about how urgent this really is for you specifically. Drop your number in the comments if you want. I do read them. Nobody enjoys voluntarily writing a check to the IRS, even when it saves you more money down the road. Your brain treats a tax bill you chose to trigger as a loss. Full stop. It treats a much bigger tax bill that just happens to you later, automatically, on the IRS's own schedule, as somehow less painful, even though it is objectively worse in every measurable way. That instinct makes plenty of sense for a one-time purchase. It works against you for a multi-year tax plan that unfolds over decades. If you have read this far, and some part of you still feels like doing nothing is easier, that is not a character flaw. It is the same instinct that has kept you out of far worse decisions across your whole life. It is just pointed at the wrong target here, in this one specific spot. So do not try to plan the next 10 years of your financial life this afternoon. Do this year's room to the next bracket number, the one from a few minutes ago, and stop there for now. 1 year, one number, one decision. Not a 10-year spreadsheet you will never actually finish building. If your honest reaction to all of this is that a few $100 extra a month in Medicare premiums does not sound dramatic enough to stress about, that is a fair instinct to have on its own. The math earlier in this video is not here to create panic about that number. It is here so the decision gets made on purpose, instead of happening to you by accident while you were not looking. None of this requires you to become a tax professional or hire one to feel in control. It requires one number revisited once a year for as many years as it takes. So here is the whole framework, in short. Find your room to the next bracket instead of waiting around for a zero-income year that might never actually come. Fund the tax on any conversion from outside the IRA, never from the balance itself. Use a 15% drawdown rule instead of a fixed calendar, so a single bad market year does not derail a plan that took years to build. And if you are charitably inclined, layer in a qualified charitable distribution once you are eligible for one. A $4 million account is not something to be afraid of, and it never was. It is a planning project with a clear set of levers attached to it, and most of those levers are entirely within your control, even if the perfect zero-income window never shows up for you, the way it seems to in the examples people show online. You did not build $4 million by accident, and you do not have to hand a chunk of it over that way either. It takes one number a year, checked on schedule, instead of a balance you only glance at and hope holds up. If you want more of this, the actual mechanics behind the number, not just the headline advice everyone else repeats, subscribe. This channel is built for exactly this kind of decision, the kind that never shows up on a highlight reel, but quietly determines how much of what you built you actually get to keep.